Hi everyone, this is a technical analysis on gold. Let's start with a fundamental overview first. The global stock market rout didn't spare gold as the precious metal fell alongside equities, although on a much lesser scale. There's a common misconception with gold. People think it's a safe haven in crisis times, but history suggests otherwise. If you look back at the most recent recessions, you will notice that gold sold off alongside the stock market. It's not a protection against the market sell-off. When there's a tightening in financial conditions stemming from an aggressive stock market sell-off, widening credit spreads, and recessionary fears, then all correlations go to one. The best times for gold is when the central bank cuts interest rates and the market prices in better growth ahead. But the absolute best time, though, is during stagflationary expectations, which we had in the past weeks and months. Those expectations got crushed by the tariffs announcement, as it was so bad that the expectations switched to pricing a recession. We are now having a tightening financial conditions, and this is going to weigh both on growth and inflation, despite the expectations of more inflation from tariffs. In fact, market based inflation expectations are going down now. The risk of more inflation could come only if the central banks start to ease aggressively and the current tariffs remain in place, in which case gold will rally hard. Conversely, if the central banks don't ease fast and the markets continue to sell off, then we will just get a recession and potentially deflation, which is a byproduct of such crisis, and in this case, gold will collapse. Of course, this doesn't take in consideration what happens with tariffs, but an easing in fears and de escalation should give gold a boost, while further escalation is likely to weigh more on the precious metal, as it would increase recessionary fears. Now, on the daily chart, we can see that gold pulled all the way back to the major trend line around the 2957 level. This is where the buyers piled in with the fine risk below the trend line to position for a rally into new all-time highs. The sellers, on the other hand, will want to see the price breaking lower to increase the bearish bets into the 2832 level next. On the 4-hour chart, we can see that we have also the key resistance around the 3057 level here. From a risk management perspective, the sellers will have a better risk-reward setup around this resistance to target a break below the trend line. The buyers, on the other hand, will want to see the price breaking above the resistance to increase the bullish bets into new highs. On the 1-hour chart, there's not much else we can add here, as we could remain stuck in a range between the support and the resistance. Nonetheless, the market participants will likely lean on the levels to position for the opposite moves and increase bets on the breakouts. These red lines define the average daily range for today. For the upcoming catalysts, this week is all about tariffs news ahead of tomorrow's deadline, so the data won't matter much. Nevertheless, we will get a couple of notable data releases. On Thursday, we get the US CPI report and the latest US jobless claims figures, while on Friday, we conclude the week with the US PPI and the University of Michigan Consumer Sentiment Survey.